Well, hello again, and welcome to Chapter 10, Valuation and Characteristics of Shares. We'll be talking today about common shares, growth models that we use in valuation, the institutional characteristics of common shares, a bit about preferred shares, and then finally securities analysis. So, common shares. You guys know a lot about these, so this is a bit of a review. Corporations are owned by the common shareholders ultimately, and of course they get to vote to choose the directors who serve on the board of directors, as you studied with Roy when you covered governance. Most large companies are widely held, which means there's a lot of different investors, so getting everyone together to vote in a block is very difficult. I think we talked about proxy voting generally. We will be talking about that in this course. Investors don't always think of themselves as owners, though, because companies are so widely held. So it's not about their vote and setting a director on the board. It's more about getting whatever dividends are available from the investment in the shares and whatever profit or losses available from selling the shares at a future date. So it's kind of shareholders see their role as more limited than it actually is, I guess, is what it boils down to. So dividends are the first part of the yield. Remember when we talk about what is the yield from a share, a common share, we have two components to the yield. The first one is the dividend or the annuity stream from those shares, and then the eventual selling price of the shares, so the future value that we'll earn on the sale of the share. And so again, if we split it up, and we just covered this Wednesday, so I don't think this is probably too far in the distance in your rearview mirror. Here are the two elements on the bottom formula, the dividend yield, and remember D1 is the dividend a year from now, so a year out, and then P0 is the value of the share today. So zero is today, times 0 is today whenever you see the subscript 0, and time 1, D1, is 1 year out. And then we've got the capital gains yield, which just means what do we pay for it in the future minus what we buy it for today, what is the market value today, divided by the market value today. And those two components give us a percentage, which is ultimately the yield of any given share. So if we want to solve for P0 and we're actually trying to figure out what we would pay for a share based on its dividend stream and its potential future value, then we could basically say, okay, well, let's just figure out the dividend, the future value, and divide by 1 plus the required rate of return. So we just need a few different elements to actually do that calculation. We'd have to have an idea of the dividends. We'd have to have an idea about how the dividends might grow in the future to contribute to the value of that share over time, and then what that share would then sell for. And I'll explain when we do the two-step growth model or the two-step model, you'll see that the P1 breaks down into some other components. So it's kind of sitting there as a nice little single variable, but it gets a little more complicated than that, of course, when we're trying to figure out what a common share is worth. Quick comparison of cash flows from shares and bonds. Of course, with the bonds, the interest payments are guaranteed and fixed, and then they only last for a finite period of time. And then at maturity, you get the $1,000, the face value. But with shares, the dividends are not guaranteed. We've talked about preferred shares a bit, where dividends are cumulative, so they're not guaranteed per se, but because they're cumulative, you can't get out of paying them. So common shares, in contrast, are not guaranteed. Companies can start and stop dividends, increase, decrease at their whim. So that can just happen. And the shares are infinite. Bonds are finite. They have a maturity. Shares are infinite. And you sell them when you sell them to whomever will buy them. And that is the market. The market determines the price. So the basis for the intrinsic share value says, okay, well, we've got these future dividends and the selling price. If we can figure out an appropriate discount rate, we can do a little estimate of all of those future cash flows. So D1 being the dividend 1 year out, D2 being the dividend 2 years out, etc. And then at the very end, whatever we get for our share, whatever P value or the price that we can get for our share in the future, that gets discounted back to time 0 to today using all present value calculations. So this is how we establish what a share should trade. So there's a lot of assumptions though, right, in that formula that we saw. So different investors will have different required rates of return. So different investors will have a different K. One investor might have lots of ability for risk and therefore expectation of return, might have a higher K because they're younger and they're further away from retirement, so they're willing to take more risk. And another investor might have a lower expectation or comfort with risk, and so they might be closer to retirement, say, and unwilling to take on a lot of risk. So their K will be lower than a younger investor, just as an example. And fundamental analysis is saying, let's take those cash flows, let's discount them to a present value, and then let's compare that to the share price for today's market for this particular share, whatever share we're analyzing or whatever company stock we're analyzing. As we discussed on Wednesday, there are a few different models we can use. Constant growth, meaning that we have an expectation of a steady percentage of growth per year. A zero growth model where we're not expecting growth at all. And then a two-stage growth model where we really use a combination of sort of constant growth or estimate of what the actual dividends are, coupled with the constant growth model at the end to basically set up the it's a perpetuity calculation at the end to say, okay, from now until the end of time, we're expecting it to grow by X percent. That's a typical two-stage growth model, which we'll talk about as we get into those slides. So the Gordon model. The Gordon model just says, okay, well, let's just take D1, which is the dividend a year out. Let's take K, which is your expected rate of return. It might be, you might share the market's expectations of the overall market's return. So, what is the market expected to return today? Probably about 8%. Or, like I said, you might have a higher tolerance for risk or a lower tolerance for risk, and therefore a higher or lower expectation of returns. So whatever your K is. And then G is just that growth rate. What are we expecting the dividends to grow by every year? And we just run it through a calculation. So it's pretty straightforward. Now, obviously, K has to be greater than G. So your expected rate of return has to be higher than the growth rate. Otherwise, this formula falls apart and you're not going to get a valuation number. So that is required. So here's an example. If we have a company that recently, now notice that it recently paid a dividend of $2.25 a share. What this question is trying to tell you is that that is D0. That is dividend today, D0, $2.25. And we have to calculate D1 to get our proper numerator on the top, or the dividend 1 year out. So we have to take that $2.25 and multiply it by 1 plus 6% to get the dividend 1 year out. So that's a really important thing when you're reading finance questions on valuing shares, is to understand if we're looking at D0 or D1 in the given information in a question. And once you know whether you've got D1 or D0, you know whether or not to multiply by 1 plus the expected growth rate, or whether you're just going to take it as is if it's an estimate for a year out. If it is D1, you're just going to take it as is. You're not going to multiply it by that extra 6% to get it to a higher number. And then we've got our expected rate of return, 11%, and 6% our growth rate. If we calculate it out, we would basically expect Atlas Motors to sell for $47.70 per share today. Now, the zero growth rate is lots of fun because it's super easy. This is our perpetuity formula. So if a dividend is going to be the same forever, the formula simplifies greatly. And all that it is the dividend divided by the required rate of return. So if we were to say, well, TELUS paid $1.79 in dividend, so D is 179, and then K is my required rate of return as an investor, and it's 10% or 12%, 8%, whatever it might be. I could figure out what I would pay for the share by running those numbers through the calculation. Very simple Gordon model. And we're going to use the Gordon model not just here to calculate P0 or the value of a share, but we're also going to use the Gordon model when we get into the cost of capital. And we're going to use this formula again to solve for K. So all of these variables are important for us to understand because we're going to be using them in the future in cost of capital calculations for cost of equity. So keep that in mind. This is something that we will see again, but in a slightly revised format. So the zero growth share is a perpetuity to the investor, and perpetuity just means that it pays forever because the share goes forever. And then if we're assuming the dividend is going to be the same forever, then this is basically a perpetuity. And we see perpetuities also in things like scholarships, where you might contribute money to an alma mater, and then they'll get a certain required rate of return out of that, and that will generate the scholarship every year that you would be giving. So that's how perpetuities work for anything. So zero growth, here's an example. The firm pays $1 per share dividend. Shareholders require a return of 20%. What is it worth? Well, pretty simple calculation. A dollar divided by 20 cents is $5 per share. And as I mentioned, here we are. We can recast the Gordon model to actually calculate for K, or the expected rate of return on any given share. So we can take D1 divided by P0 plus the growth rate to figure out what K is, or the return possible from this particular share. If we know the expected growth rate, if we know what the share is currently trading for, P0, and what the dividend will be 1 year out. Now, two-stage calculations are basically breaking the dividends up into cash flows year by year by year, and then applying whatever tools and models we have. They're all discounting, like they're all present value calculations ultimately. So if you get concerned about what formulas to use and how they work, just remember we're ultimately just doing present value calculations. We're just trying to take an infinite stream, though. That makes it a little more difficult, and at some point that perpetuity formula is really important because shares go on forever. They're not a fixed stream of a fixed length stream like an annuity. They go on forever, and so at some point we need to calculate the perpetuity part of the value of the share and then discount that and bring it back. So we generally use the Gordon model if we know that it's going to grow at a constant rate for a little while, and then we can do the non-constant growth period after that. So we use whatever tools we've got depending on the information we have on the share. So what you do when you're faced with a two-stage growth problem for shares, and I will definitely have a near do one with you guys, and I think there's some already posted to course bases, but I'll double check. You draw a timeline of the cash flows, so you're clear. D1 is what amount, D2 is what amount, D3 is that now something constant going forward. And you map out your cash flows so you understand exactly what's happening with dividends. And remember, you're only using the dividends to figure out the value of the share. We're not worried about the sale of the share in the future because we're assuming that we're going to hold it forever, and that value of holding it forever would be equal to the value of having a finite amount of dividends and then selling the share for a capital gain or loss. So we're going to use dividends forever as a stand-in for those two components to the value of shares. Now, so calculate each dividend, put it on the timeline, and then you have to present value the dividends back to time zero, right? That's pretty straightforward. The hard part is that at some point you've got constant growth going forward, and you have to do a calculation of the present value of those infinite perpetuity related streams, dividend streams. And when you do that, you have to still discount that back a little further because that typically doesn't happen in the first year. Somewhere in year 3, 4, or 5, you're saying, okay, now this goes on forever. And I'm going to calculate the perpetuity value of all of those dividends forever. And then that comes up with a number. But the problem is that number is like P3, the value of the share in year 3 or year 4, depending on, when it starts to actually be a normal growth, depending on the question basically that you're given. So that P3, we need to get the present value of that future value. We need to discount it one more time to get it all the way back to P0. So and we'll do those calculations. Don't worry, you'll do some of those with the near for sure. Practical limitations of pricing models. Share valuation models only approximate. There's obviously not guaranteed cash flows because dividends aren't guaranteed. Interest guaranteed. Dividends not guaranteed. And growth rates and interest rates can be very different from predicted rates. How long, 7 years now, I think, we've been predicting that rates are going to go up. And, 5 years ago, we were just waiting for them to go up substantially and fairly quickly. And here we are. They're going up, they're crawling up, but they're nowhere near what anyone would have predicted they would be 7 years out. Shares that don't pay dividends can still have a substantial share price, but we have nothing to value them with. This dividend tool only allows us to calculate the value of shares that have dividends. So a whole suite of shares out there that don't pay dividends, we can't use this tool to actually figure that out. If they're using their profits to finance growth, we can kind of say, okay, well, what would they be paying out in dividends if they could? But that's a lot of estimation again. And distant dividends do impart value. So at some point they might pay dividends once they finish their growth and getting their customer base all together. Now, you guys are familiar with all these governance pieces, so I'll go through them fairly quickly, but post any questions that you have to the discussion board on Core Spaces. As you know, the board of directors is really the controlling aspect of the organization. They hire and fire and manage the CEO. They're elected by shareholders, and they very often have some say, at least say on pay, on the next layer below the CEO. Now that comes and goes. Sometimes the board members see themselves as having one employee, and sometimes they reach down into the next level. And they're reaching down to the next level a little more here in Canada because of succession issues. There are so many anticipated retirements among the executive ranks that the boards are needing to have a little more visibility into not just the CEO, but the next level down at least, and also with say on pay sort of being something that investors want to see. There's the compensation committee of the board that's often looking at not just the CEO, but the CEO and the next level below that. So shareholders, they get to vote at shareholder meetings. Obviously, they share in profits and then the residual assets if something were to go wrong with the company. Preemptive rights were an automatic right in British Columbia up until about 7 years ago, and it depended on the province. They were automatic preemptive rights in other provinces sometimes and not in other provinces. The idea of preemptive rights is if I'm a shareholder of a company, say I own 10% of a company, if I have preemptive rights in my shareholders agreement and the company's going out to raise $1 million, I have the first right of refusal to write a check for $100,000 to maintain my 10% in the company. So it's an opportunity to maintain whatever percentage I have. Now, those preemptive rights were eliminated across the board to normalize across all the provinces and make sure that they were consistent. So none of the provinces have automatic preemptive rights anymore. So shareholder agreements determine whether there are preemptive rights in any given company. So it's something to look into if it interests you. It's a way of protecting yourself as an investor. You get to maintain your percentage if you think the company's going to do well. But you have to write a check to do it if they're raising money. So, voting for the board of directors, each share generally carries a vote. That's not true of all common shares. Some common shares, so you might have a Class A that has 1-for-1 voting. You might have a Class B that has 4-to-1 voting, and you need 4 shares for the equivalent of 1 vote of a common Class A share. But when we're talking about sort of simple characteristics of common shares, we just say, well, these are voting shares. Each share carries 1 vote. So it's a 50% thing in terms of electing a director. If you have more than 50% of the votes, you get to pick the directors. So that's a pretty good deal. And it gives the control of the company to a large group. It gives the control of the company to the majority shareholders, basically. Each share carries as many votes as our directors. Shareholders may cast all votes for one candidate. Gives minority interest a chance for someone on the board. Cumulative voting is not common in Canada. We tend to have majority voting. Yep, shares can be issued with limited or no voting rights, absolutely. Or like I said, 10-to-1 or 4-to-1 ratios. Now, preferred shares are an in-between security. They're kind of like debt and they're kind of like common shares, and they're somewhere in the middle between them. They have no maturity date, so that's like common shares. They have a fixed dividend payment, which is quite similar to bond interest, and that fixed dividend payment is based on the face value of the preferred share because they have a face value. That's the next probably. And then you multiply it by a percentage. So say it's 10% of the face value and your preferred share has a $50 face value and the dividend is 10%, then you would get $5 every whatever period the dividend is to be paid upon. And cumulative feature is that common dividends can't be paid unless all of the accumulated owing preferred share dividends have been paid. So they accumulate if they're not paid. They're not guaranteed, but they accumulate and they're owed at some point if the company can be good on them. The valuation of preferred shares is really easy because they have a constant dividend. We just use the constant formula. Dividend is today is tomorrow is the same, so it's the same annual number of whatever D is, and K is your required rate of return. So it's a very straightforward calculation. It's a no growth rate calculation, a perpetuity calculation essentially. So here's a good preferred share example, $6 preferred share sold for $50. Interest rates on similar issues are now 9%. So $6 dividend, 9% required rate of return means that you should pay $66.67 for this particular preferred share if it's available in the secondary market. Just some last sort of graphs, which are nice summaries of the different types of securities, preferred, common, bonds. If it was me, I would actually have common preferred bonds to show that preferred are between common and bonds, or bond preferred common, either way, because preferred is a bit of a hybrid between common shares and bonds. But at any rate, it's a nice summary here. Take a look at it at your leisure. Please ask if you have any questions, because I think we've covered all of it. And I think, yeah, we've covered all of it. So I don't think there's anything in here that's unusual. So any questions, just ask. Securities analysis includes selecting investment, and fundamental analysis looks at the company and its business to forecast value. Technical looks more at the market and patterns that are happening in the market. And the efficient market hypothesis is just that there are no real good deals out there. The market moves too quickly and will move if there is a good deal out there very quickly. So there's not a lot of value to be found in the market because it's extremely efficient. So those are some of the key concepts underlying security.